Today, we're going to give you value by showing you the many different ways to finance your real estate properties, starting with houses and moving up to multifamily. There's lots of different benefits and drawbacks depending on the different loans that you do. First of all are like traditional mortgages, loans where you're buying a house or a duplex or up to 4 units. After 4 units, you're not going to be doing an FHA loan or a traditional mortgage. I do like FHAs because you can put as little as 3.5% down and even 1.5% sometimes. And for beginner investors to get their foot in the door with low to no down, a little bit down. Moving on to private money lenders and hard money lenders. I love those, especially if I'm the one doing the lending. If you're the lender on that, that's great, because I would lend you money and you, the borrower, would need to secure it with real estate that you own or something else of value that I, the lender, can put a note against your property, charge you a point or two for the transaction, and then have you pay me a payment for the capital borrowed. Typically, you pay 10 to 12% for a hard money loan, so sometimes it's almost double what you would typically pay, and it's worth it if you buy income producing real estate. If you borrow hard money and pay 10 to 12%, you wouldn't want to go buy cars, expensive trips. But if you get a hard money loan to buy an asset that you know is going to go up, that you're going to take care of and fix up, it would be worth it. It's usually really fast too, so if you need the cash fast, as long as you have the real estate to secure their position, you can get the cash sometimes in a week or within a couple weeks, as opposed to dealing with a regular bank on multifamily, which takes about 60 days. Real estate syndication used to be more popular a year, 2, 3 years ago. It's not as popular now. There's a lot of fees involved in that. That's good for people that want to give their money to someone else and have them be the investor for them. And it's good if you have money sitting in, say, a 401k or a bank account. It would be better to be with a syndication or a REIT, a real estate investment trust, as opposed to having the money sit in the bank. And real estate syndication is also a bunch of people or a few people pooling their resources together. I'm good with a small syndication, me and 3 or 4 buddies. I could do a syndication like that. What I wouldn't want to do is hundreds of people. Although like crowdsurfing or crowdfunding, that's what they're doing. The more people, the better. Grant Cardona's doing that and he's killing it. More power to you, brother. Equity and joint ventures is more like a couple people go in, one person could do the work, other person provides the equity. Crowdfunding and REITs are more where you go online and you get a bunch of people to donate, typically smaller amounts, pool all the money together and then go buy a deal or two. Again, the person putting the money in is getting a smaller return rather than doing more of the work. And if you don't know what you're doing, that's a good idea. It's also a good place to start, because a lot of the times they'll have a portal so you can watch the projects as they go and you can learn and then be ready to go out on your own and do your own deal after that. Home equity loans, I love, especially if the debt is good. If the debt is high, I don't love them so much. But what I did back in the day with home equity lines or loans, I would buy a property and then I would borrow against that property, have a loan, and now go buy another property with that money. Build that property up that I got based on the new value, borrow against it, and repeat that. That's a great way to start. If you have a couple $100,000 sitting around, you go buy one little house or duplex, fix it up, get it right, borrow against it, keep getting positive income from the renter, and go buy another property. Repeat that a few times. When the market changes, the debt market, you'll be in good shape. 401k and retirements are great if you have a corporate job or a state job and you just put a little bit aside. That's great. It accumulates over time. If it's a self-directed 401k, I like it more because you control where the money goes. And it's great for tax savings as well. Bridge loans are great because sometimes you want to get in a project, you want to get it going. It's similar to a hard money lender, although the fees and the interest rate is not typically as high. A bridge loan is a short-term loan, 12 to 24 months, typically gonna borrow this money to get this project right, and then have a new bank come in, take care of that, and have one new good loan. So I like bridge loans on the right deal. I wouldn't want a bridge loan just to do any deal, but if it were a great deal, just like hard money, I would definitely entertain the idea of using bridge loan, and I have for the right deals. Comparing financing options, you definitely want to do that. You want to look at all the options, and there's many ways to go. And sometimes some banks say no on certain deals and they say yes on other deals. So you want to sit down at the end of the day when you decide to borrow the property and weigh your options. Some are better if you put more money down up front. Some are better if you stretch it out or over 30 years or more, amortized or not amortized. Sometimes seller financing, which we'll get to in a minute, you can get lower interest than the bank. That's why I love seller financing so much. There's a lot of ways to go. There's a lot of money out there that you can borrow, especially when you have properties to collateralize the cash. Seller financing is my favorite, especially these days, because we're in a tough debt market. So money is expensive to borrow. Even if you have a lot, even if you have a lot of assets, the price you pay for money is expensive now. Seller financing is the way to go if you can get it. When brokers call me, which they do every day, "Hey Chris, I got a deal, are you looking for it?" Rather than asking the price, I ask, what's the debt? If the debt's 4 or 5%, or it's a seller that's willing to work with me, I'd rather do that than pay 7 or 8% at the bank. So seller financing is very, very important. Typically sellers don't want to do that because they don't understand it. But if you can sit them down, get them to understand it, it could be a great deal for everyone. And I've done it many, many times, and I hope to do it many more times. And if I'm selling and I'm seller financing a building, I want a higher down payment and higher interest. But if I'm buying your building, I want the lowest down possible and the lowest interest rate possible. So if your deal is $5 million, the bank wants $2 million down. Maybe if you're gonna seller finance for me, I could put $500,000 down or $1 million down. And if the bank wants 7%, maybe you, the seller, would carry it for me for 4%. The deal starts making more sense. So the price becomes less important when the terms become more favorable. Please subscribe, keep watching my videos, and the next one to come is seller financing. I love seller financing. Please continue to follow me.